Welcome. You're listening to The Deep Dive, the show that cuts through the noise of earnings calls to bring you the essential insights.
That's right.
Today, we're dissecting the Q2 fiscal year 2025 earnings conference call for Floor and Decor Holdings, FND. And what's really fascinating about FND right now is how they're navigating a housing market that's been, well, let's just say, less than cooperative.
Yeah, challenging is putting it mildly.
Exactly. So our mission today is to sort of unearth how they're managing to not just survive, but actually show some, surprising resilience. We want to help you quickly get well informed on what's genuinely driving this business and what the street is scrutinizing.
Absolutely. In a dynamic market like this, understanding not just the raw numbers, but the underlying strategy and their competitive positioning is just crucial.
Right.
We'll explore why these results matter for FND and, frankly, for the broader home improvement sector, too. We'll provide you with the essential context and, the implications you need to see the full picture.
And the market reaction seemed, relieved.
Yeah, the immediate reaction suggested a sense of genuine relief rather than just wild exuberance, So we're going to approach this deep dive with, let's say, a bullish to neutral lens. We'll highlight both their significant wins and the areas that still warrant a watchful eye.
Okay, good plan. All right, let's kick things off with the headline numbers, because this is really where the story of F&D's resilience starts to take shape.
Let's do it.
For the second quarter of fiscal 2025, F&D reported GAAP earnings per share of $7.58. Now, that comfortably beat consensus estimates, which were, 76 cents?
Yep, 56, so a nice beat there.
And revenue came in at $1.214 billion, pretty much right in line with expectations, and that represents a healthy 7.1% increase year over year. But here's where it gets really interesting, beyond just the headline beat.
Exactly. The fascinating, almost defiant part here is that the company delivered its first positive comparable store sales increase since way back in the fourth quarter of fiscal 2022.
Wow, that's a long time.
It is, clocking in at 0.4% positive. Now, think about that for a moment. In a housing market that's been, largely hitting rock bottom, this is a really significant turning point after a long period of declines. It's a genuine operational triumph, I think.
No kidding. 0.4% might sound small, but context is everything here.
Precisely. And beyond that, operating income reached $81.9 million. The operating margin actually improved by 50 basis points year over year to 6.8%.
So half a percentage point improvement there.
Right. And adjusted EBITDA, which is, basically earnings before interest, taxes, depreciation, and amortization, that grew by a strong 9.7% year over year to $150.2 million. And the margin improved there, too, to 12.4%.
So solid performance across the board, operationally.
These figures really underscore management's disciplined execution. And the market's initial reaction, like you said, while maybe not a parabolic surge, it certainly indicated a clear positive shift in sentiment. It really showed investors are noticing their ability to perform, even in these tough times.
Okay, so that positive comparable store sales figure, the 0.4%, it isn't just a number. It immediately begs the question, how on earth did they manage this in such a tough environment?
That's the key question.
Let's unpack this financial performance a bit more. That 11.5% increase in diluted EPS to 58 cents, hitting the high end of their own expectations, clearly speaks to some strong cost discipline.
Yeah, absolutely.
And Brian Langley, the CFO, he specifically noted that the gross margin rate actually improved by approximately 60 basis points to 43.9%. It's pretty impressive, especially considering it was mainly due to lower supply chain costs.
Yeah.
What does that tell you about their operational agility?
Well, what's truly insightful here, I think, is how it illustrates the inherent cash generative nature of their store model. Even when the broader economic currents are against them, despite this challenging macroeconomic backdrop, their ability to effectively manage gross margin and achieve SG&A leverage, which basically means they're growing sales faster than their overhead, that significantly offset lingering freight inflation. Right. That's a direct line to that EPS beat we just discussed. It's not just about cutting costs randomly, it's about optimizing their entire operational pipeline. Very strategic.
Makes sense.
And we also saw them open 3 new warehouse stores in Q2. That brings the total up to 257 locations, which is up about 12% from last year.
Still growing the footprint.
Yep. And they remain firmly on track to open 20 new warehouse stores in fiscal 2025. That's continued expansion, even in this difficult climate.
So on that expansion point then, they reiterated their multi-year path toward 500 plus locations. But what I found interesting is they're maintaining a disciplined capital expenditure envelope, right? Around $280, $320 million for the year. This isn't just growth at any cost, is it?
No, definitely not.
Does that signal maybe a more cautious approach, or is it simply smart navigation given the current economic uncertainties?
I think you've hit on a critical distinction there. This expand efficiently playbook is absolutely key to their long-term strategy. It demonstrates a profound commitment to disciplined and agile growth.
Agile, yeah.
They're explicitly prepared to adjust their expansion plans should the housing market or, the broader economic environment underperform. It means they're not just blindly chasing a store count number, they're optimizing their investments for maximum return.
So they have levers they can pull.
Exactly. This prudent capital allocation isn't just about weathering the storm. It's vital for long-term value creation. It's the difference between expanding recklessly and expanding sustainably, really adapting to market signals.
That adaptability seems crucial right now. And beyond just opening new physical locations, FND is clearly executing on other strategic priorities to drive sales in existing stores, deepen customer relationships.
Right. It's not just about new stores.
We heard a lot about their better and best tier products continuing to resonate with customers, which directly contributed to higher average tickets. What exactly are these tiers, and how are they managing to drive customer behavior with them?
Yeah, it's a clever merchandising strategy. The better and best tiers essentially refer to higher quality, more premium flooring products. Think more complex tile designs or maybe superior wood finishes, that kind of thing.
Gotcha.
By positioning these, FND encourages customers to trade up, to perceive greater value in these higher priced options. This isn't just about selling more, it's about selling more profitably.
Fine.
And this also ties into their connected customer sales, which now account for, what was it, about 19% of total sales?
19%, yeah.
And this is driven by healthy growth in weekly active users and organic traffic to their digital platforms. It shows their online presence is a real funnel, bridging that digital experience with the in-store purchase.
And the design services pillar.
Yeah.
That really seemed to stand out. Delivering strong sequential and year-over-year growth, they mentioned a significantly higher average ticket and gross margin rate when designers get involved. How does that work, and what makes it such a powerful driver for them?
Oh, that's a fantastic point. Design services are a genuine competitive differentiator for F&D. It's huge.
How so?
Well, instead of just buying a product off the shelf, customers are getting professional guidance for their entire project. This often leads to larger, more complex purchases, entire home renovations rather than just redoing a single room floor.
Yeah, bigger scope.
Right. When a designer is involved, the customer's confidence increases, and they're much more likely to invest in those better and best tier products we just talked about, which, as you mentioned, carry higher margins.
Okay, that makes sense.
It builds loyalty, creates a more comprehensive solution for the customer, and essentially transforms a transactional sale into a relationship-driven project that locks in a higher overall spend and boosts profitability significantly.
This raises an important question, though. How are they truly differentiating themselves in what is a pretty crowded market? You talk about their competitive moat, but aren't larger retailers like, say, Home Depot or Lowe's also investing heavily in their pro services?
Yeah.
How unique is F&D's advantage here, really? And how hard is it for competitors to just copy it?
That's a really valid challenge, and it gets right to the heart of their competitive edge. While, yes, the larger players certainly have pro offerings, F&D's specialized focus on the professional customer, remember, that's about 50% of their sales, allows them to go much deeper.
50%, wow.
Yeah. Their pro business continues to outpace the overall company growth, fueled by increases in both transactions and average ticket size. They're not just selling to pros, they're actively deepening pro loyalty through initiatives like the dedicated Pro Desk experience, robust field engagement teams, and extensive community events.
Community events.
Get this, they hosted 43 in-store educational events, specifically for pros in Q2 alone.
43 in one quarter.
Yeah, that's almost one every 2 days. It's about building a community and providing genuine expertise, not just shifting boxes. It's a different level of engagement.
Okay, that's impressive dedication.
And we can't forget the commercial segment, Spartan Surfaces. That delivered stronger than expected sales, too. June was apparently their best month in history, focusing on those high-specification sectors like healthcare and education.
Right, more diversification.
Exactly. This diversification of customer base and service offerings really strengthens their competitive moat, making them less reliant on just the individual DIY consumer. It's a truly different business model compared to the big boxes.
Another critical point I picked up was their robust strategy for mitigating tariffs. That's been a headache for so many retailers.
Oh, yeah, huge.
They discussed active negotiations with vendors, a highly diversified sourcing network, something like 240 vendors across 26 countries, and a balanced approach to product pricing. And it was also notable to hear that the United States is now their largest country of manufacturer, accounting for roughly 27% of products sold in fiscal 2024. That's up quite a bit from around 20% back in 2018. Why is that specific detail about U.S. manufacturing so important for their competitive positioning?
That's an excellent observation, and it highlights a key strategic advantage. This direct global sourcing model, coupled with their increasing domestic manufacturing, provides just immense competitive leverage, especially against smaller, independent flooring retailers who are getting squeezed much harder by tariffs.
So scale and control matter here.
Absolutely. By sourcing directly from this vast network and producing more domestically, FND reduces its reliance on any single country or supplier. It makes their supply chain more resilient and, crucially, more cost-effective.
Right.
Management explicitly talked about their commitment to maintaining pricing gaps and reinforcing their everyday low-price message. That's much easier to do when you control your sourcing so meticulously.
So it's not just talk.
No. And their competitive advantage isn't just about price either. It also includes those broad assortments and impressive ability to keep job lot quantities in stock, meaning enough product for large projects, and having highly knowledgeable associates on the floor.
That in-stock part is key for pros.
Critical. And they've also been very surgical with pricing. They avoided that peanut butter spread approach of just blanket price changes across the board.
What do they do instead?
They use pricing tests to really understand elasticity and make target adjustments only where they know the market can bear it without losing significant volume. This lets them optimize margins while still maintaining their core value proposition. It's smart.
Okay, so understanding how they're winning locally leads us naturally to the bigger picture, the larger economic landscape they operate within. Let's shift to the macro picture and the company's outlook for the rest of fiscal 2025.
Right, the external environment.
The U.S. consumer, while, broadly resilient overall, is clearly facing challenges, especially when it comes to discretionary big-ticket durable goods and those large renovation projects.
Definitely feeling the pinch there.
This is largely due to elevated mortgage rates, still hovering above 6.6%, and just all-time high home prices. It's significantly discouraging both first-time and existing buyers from entering or even moving within the market.
It's putting a damper on housing activity, for sure.
And existing home sales, which are a key indicator for this business, they sequentially fell to 3.93 million units in June. That marked a 9-month low. That's a really tough environment to be growing in.
It absolutely is. And this challenging macro environment, unsurprisingly, heavily influenced their updated fiscal 2025 guidance.
How so? What do they guide?
They now anticipate total sales between $4.66 and $4.75 billion, and comparable store sales are estimated to be somewhere between down 2% and flat for the full year.
Down 2% to flat comps. Okay.
And diluted EPS is projected between $1.75 and $2. But here's the crucial insight from that guidance. It explicitly reflects that they are not banking on a significant improvement in these housing market conditions for the rest of 2025.
So no rosy scenario built in.
Exactly. It shows a realistic, maybe even conservative approach. They're focusing on their internal initiatives to drive growth, even if this extended bottom in the housing market, as they called it, persists. This isn't wishful thinking. It's a strategic recognition of the current reality.
So what does this all mean if the market truly does continue to bounce along the bottom, as management described it? They seem to believe that due to easier comparisons year over year and their internal initiatives, the business should still start to grow, even with flat overall housing. But what are the underlying risks? What could derail this turnaround, especially if that sluggish housing market persists even longer than expected?
Yeah, that's the million-dollar question, isn't it? Management certainly believes they can continue to take market share through those enhanced in-store experiences, the growing commercial opportunities, and just leveraging their scale. The risk, of course, is if the macro environment deteriorates further than what they factored in.
Or competition heats up more.
Or if competitive pressures intensify beyond their current advantages, sure. However, they did highlight that their more mature stores, the ones open 5 years or more, are still highly profitable. We're talking 23% EBITDA margins, even if their volume is down from the peak levels.
That's a strong baseline.
It really is. It's a testament to the fundamental strength of their specialized model. They can still generate significant cash even with reduced traffic overall. They're really steering toward a story of Measured expansion plus margin rebuild.
Measured expansion plus margin rebuild.
Okay. And they see catalysts ahead, too. They're looking for that September quarter comparable sales inflection, meaning they expect comps to turn positive again soon. They've got holiday merchandising resets coming up, and of course, the continued pipeline of new store openings.
The potential upside drivers.
Yeah. If comps stay positive and those new stores hit their productivity ramps as planned, the stock's multiple could potentially re-rate. Investors might start valuing each dollar of earnings higher, maybe closer to its historical mid-30s PE. That would be a significant move from where it is now. It's a strong vote of confidence in their internal drivers, despite the macro.
Okay. That sets the stage nicely. Now for the segment you've all been waiting for. This is not financial advice. As always, this is purely for entertainment, maybe stimulate your thinking a bit. Think of it as a wild yet plausible trade idea pitched to an investment committee.
All right, let's have some fun with this. Picture this scenario for a moment. In this choppy, challenging home improvement market, where even the giants like Home Depot and Lowe's are guiding to flat or, pretty soft sales.
Yeah, tough sledding for them too.
Our audacious trade idea is to initiate a paired long-short position, go long Floor and Decor Holdings, FND, and simultaneously short a basket of those large-cap, traditional home improvement retailers.
Okay, long FND, short the big guys. Explain the rationale there.
The rationale for the long FND leg is, simple yet powerful, I think. FND has proven its ability to kind of defy gravity here. While both FND and its peers face these macro headwinds for mortgage rates and the sluggish housing market, FND has consistently gained market share and executed that disciplined expand efficiently playbook we talked about.
Right, the execution piece.
And that first positive comp store sales number in years, it really underscores not just operational resilience, but a unique business model that's working. They're winning on multiple fronts.
Like what?
Well, their superior tariff mitigation strategy, that direct global sourcing, increasing U.S. manufacturing gives them a cost and pricing advantage that peers just don't have to the same degree. Their competitive moat isn't just widening on price and assortment, it's built on the really profitable traction of their pro business, which, remember, is growing faster than the company average.
And the design services.
And those high-margin design services are proving to be a sticky, revenue-accretive pillar. Crucially, management isn't banking on a macro rebound. They're guiding based on continued internal strength.
So any housing improvement is gravy.
Exactly. Any improvement is pure upside. But even at this bottom, they expect to continue growing through market share gains and strategic initiatives, like their new outdoor product rollout and continuous in-store improvements. It's like they're building their own tailwind when everyone else seems stuck fighting a headwind.
Okay, I get the long F&D argument. But why short those established industry titans in the same sector? That feels a bit like betting against the house, doesn't it? What's the core argument for that short leg of the trade?
Precisely. The outrageous part is betting against the established industry titans. It feels counterintuitive.
Yeah.
But the plausible part comes from understanding their relative exposure. For the short leg, these large-cap peers, while incredibly well-managed companies, are fundamentally more broadly exposed to the general DIY consumer and those higher-ticket discretionary spending segments.
Which are hurting more right now.
Exactly. Those are the very areas feeling the brunt of the current economic pressures, particularly from inflation and high interest rates. F&D's surgical pricing strategies, their in-stock advantage for job lot quantities, their deep engagement with the professional segment. It seems like they're actively siphoning demand away from these more generalized retailers.
So F&D is taking share directly from them.
It appears that way. They're essentially chipping away at the foundation of the traditional home improvement market, piece by piece. F&D's distinct business model, its execution discipline, and its clear competitive advantages seem to create a rare alpha opportunity in an otherwise challenged sector. Meaning this suggests their valuation multiple could re-rate higher as they continue to demonstrate sustained outperformance and that margin rebuild we discussed, while the traditional players might see their multiples compress a bit due to their more direct macro exposure. It's a relative value play based on execution and model differences.
Okay, a compelling, if bold, idea. So there you have it. F&D's Q2 FY25 earnings call highlighted a company that's truly demonstrating disciplined execution and strategic agility.
Yeah, agility is a good word for it.
They've achieved a significant milestone with those positive comparable store sales in what is, by pretty much all accounts, a profoundly challenging macroeconomic environment. It's a compelling story of measured expansion, that margin rebuild, and a relentless focus on internal initiatives to drive market share.
And here's maybe the provocative thought for you to consider as we wrap up. If Floor & Decor can achieve its first positive comparable store sales amidst what management themselves describe as an extended bottom in the housing market, what does this truly say about the fundamental strength and adaptability of their business model?
Good question.
Could their specialized focus on the professional segment and those high-value design services fundamentally reshape their trajectory? Could it make them significantly less susceptible to broad housing cycles in the long run compared to others? Is this maybe a new blueprint for success in the home improvement space? Something to think about.
Definitely something to think about. Thank you for joining us for this deep dive into Floor & Decor Holdings. We hope this exploration has provided you with some valuable, actionable insights.
Hope so.
Join us next time for another deep dive into the numbers that matter.